Investing in the stock market can be really tedious at times. Today, as we analyze the fundamentals of Tesla stock, we're going to look at some information deciphered from Jim Cramer. So stay tuned. The Federal Reserve Chair, Jay Powell, has mentioned that the Fed's bond buying program, a program which it already indicated would be winding down as the pandemic subsides, but recently he seems to have changed his tune. Powell said bond buying would be ending sooner than expected, and that was all it took to send investors into a panic. The news itself was obvious, Cramer explained, but the timing couldn't have been worse given investors' worries over the Omicron variant. What does all of this mean for the average index fund investor? Not much, Cramer said. Individuals are buying stock for the long term, which makes today's short-term weakness nothing more than a buying opportunity. He remained cautious, however, telling viewers to wait until the first confirmed case of Omicron in the U.S. That event will likely spur even more selling and hopefully mark a short-term bottom. In the meantime, investors can still buy technology stocks like Amazon, Microsoft, and Tesla. They can also buy the dividend stocks, which will continue to do well in this environment. At the end of the day, it's better that the Fed announced its plans. Now that the damage is done, the markets can begin to move forward. Cramer explains that there are 4 types of sellers in as far as stock trading is concerned. The first group is scared of inflation and will use every opportunity to scare you out of stocks. The second group knew that the Fed would tighten, but didn't expect it this fast. The third group is just trying to lock in their gains so they can buy back in at lower levels. And then the fourth group is worried about an Omicron slowdown. The problem is that all of these groups can't be right. If there is a slowdown, then the Fed won't tighten as fast. And if the Fed does tighten, then things must not be as bad as we thought. That means that there will be buyers returning to the market soon, which is why it makes sense to use the weakness and do some buying. For starters, let's talk about Amazon. Most people think of Amazon as an e-commerce company, and for good reason. It has become the online marketplace of choice for millions of consumers around the world. But the company also participates in 2 other expanding industries, both of which could fuel significant growth in the coming decade. The company competes in 3 high-growth industries. You've got e-commerce, cloud computing, and digital advertising. The market cap is $1.7 trillion right now, and that's expected to go higher in the coming years. Just to put its competitive edge in perspective, within the U.S. e-commerce market, Amazon holds 41% market share. The next closest competitor is Walmart with 6.6% market share. So it's multiple times higher than the next closest competitor. And in cloud computing, Amazon has 32% global market share. The next closest competitor is Microsoft with 21%. That cloud computing side of its business, AWS, the operating margin on AWS was about 29% in the most recent quarter compared to about 4% in its North American e-commerce business and 1% in its international e-commerce business. This is the cash flow growth engine for the company. If you're an Amazon shareholder, one thing you might be concerned about is that they've generated negative free cash flow over the last 12 months. Cash from operations actually dropped about 1.2%. The company is investing aggressively in building out its fulfillment network. Even now, during the most recent quarter, CEO Andy Jassy mentioned that Amazon almost doubled the size of its fulfillment network since the beginning of the pandemic. Well, we think that enables them to provide that great delivery experience for customers and reinforces their competitive advantage. On the other hand, Microsoft is expected to release second quarter fiscal 2022 earnings on January 25th. In examining first quarter financial year 2022 results and full year fiscal 2021 results, nearly all segments have shown significant growth, except for devices. Server products and cloud services, which encompasses Microsoft Azure and several other items, are the clear growth driver, and investors will want to see continued advancement here. Microsoft's margins have been rising lately, which is terrific news for shareholders. The EBITDA margin is above 50%, and that's especially impressive. Much of this can also be attributed to the increased operating income from the intelligent cloud. Microsoft continues to show a solid balance sheet position despite the significant return of capital to shareholders through buybacks and dividends. The company reported over $130 billion on hand in cash and short-term investments, compared with $50 billion in long-term debt in the last report. The cash and short-term investment balance account for over 5% of the current market cap. All told, the net debt puts the enterprise value at $2.24 trillion, or about $50 billion less than the market cap. Shareholders can expect a similar capital structure when the second quarter earnings are released. Microsoft's recent dip from its all-time highs may represent a solid entry point or opportunity to accumulate more shares. Given the current valuation and the market conditions, incremental purchasing may be the best option for long-term investors. So what about Tesla stock? Elon Musk is expected to return to the earnings call. Does that mean good news? Tesla is expected to report fourth quarter earnings, with investors expecting a return of Chief Executive Elon Musk to the post-results call and bracing for what could be worrying news for the Cybertruck and supply chain snags. Musk told Wall Street last year he was unlikely to be on future Tesla earnings unless there's something important he needs to say, and he wasn't at the EV maker's third quarter call in October 2021. There have been reports that the Cybertruck, an unconventional-looking electric pickup truck unveiled in 2019, has been delayed. The truck, Tesla's first foray into an auto body-style U.S. residents have favored for decades, was expected to start production this year and reach volume production in early 2023, which already would have been a few years behind schedule and several months later than electric pickup trucks by General Motors, Ford, and many other OEMs, as well as newcomers such as Rivian. So what does that mean for Tesla? Should investors expect some great news? Tesla surprised Wall Street earlier this month with record fourth quarter sales, which surged nearly 90% from the same period in 2020. All signs point to another strong quarter for Tesla, which has put together an impressive streak of earnings beats. The record quarterly production and sales give Tesla a significant bottom-line leverage given the high fixed cost nature of auto manufacturing. Focal points for earnings include Tesla's 2022 guidance, timelines for production ramp-ups at new factories going up in Texas and Germany, especially in the face of semiconductor shortages and supply chain issues, and next steps in its long-term growth plan to increase annual production by a factor of 40 between 2020 and 2030. Even without that direct guidance, Emmanuel Rosner at Deutsche Bank is expecting a positive update from Tesla on growth and margins potential for 2022 and on cadence of new product and technology. Other potential highlights for the quarter include timing of the production ramp-up for Tesla's new factories in the Austin, Texas area and in Germany, and details about its alternative energy business, the status of its in-house battery production, and sales in China. Piper Sandler analyst Alexander Potter also believes that Tesla should theoretically have enough capacity to exceed production estimates with the two new factories coming online. But he also says that China's zero-COVID policy could threaten operations in Shanghai. Well, Tesla started 2022 on the right foot by reporting it delivered more cars than expected in 2021. So there's no reason why it shouldn't continue to have a great year. Tesla is the biggest player in this industry due to its cutting-edge technology and customer loyalty. That means it'll naturally be a beneficiary of this industry's growth. So that's it for today. Be sure to drop some comments on the comments section. Don't forget to like, share, and subscribe. See you next time.